How does inflation change investment sector performance in retirement portfolios? Imagine a world where the money you save today might buy less tomorrow. That's what inflation does. It erodes the value of your cash and fixed income investments over time. For seniors, this means their retirement income needs to grow enough to keep up with rising prices. Different sectors react to inflation in their own ways, which impacts how your portfolio performs. When inflation rises, cash and traditional bonds often lose value because their returns may not keep pace with increasing prices. This can reduce your real income, making it harder to cover everyday expenses. Stocks, on the other hand, tend to do better over the long run because companies can raise prices to protect profits. But in the short term, inflation can cause market swings and lower your actual returns, especially if inflation surprises everyone. Some sectors tend to handle inflation better. Consumer staples and utility companies often pay steady dividends and can pass some of the higher costs to consumers. This makes them more stable choices during inflationary periods. Energy and materials sectors usually benefit because commodity prices like oil, gas, and metals tend to rise with inflation, boosting profits for companies in these industries. Real estate investments also act as a good hedge because property values and rental incomes often increase with inflation, helping preserve your purchasing power. Technology and growth sectors can struggle during high inflation. Rising interest rates, which are often used to fight inflation, make borrowing more expensive. This can slow down growth and reduce future earnings for tech companies. For retirees, diversifying across these sectors and including assets like Treasury inflation-protected securities can help. These securities adjust their payments based on inflation, protecting your income. A balanced approach is key. Holding stocks for long-term growth, bonds and Treasury inflation-protected securities for income and inflation adjustment, and real estate or real estate investment trusts for inflation-linked income can create a resilient portfolio. Cash reserves are also important to cover short-term needs and avoid selling investments during market downturns. As you move from saving to spending in retirement, your portfolio should become more conservative. But keeping some exposure to growth sectors and inflation-protected assets helps fight inflation's impact. Regularly reviewing your investments and working with a financial advisor can help you adjust your strategy based on inflation trends and your personal needs. In the end, inflation influences sector performance by favoring those that can pass on costs or benefit from rising prices, while fixed income and cash may lose value. For seniors, a well-diversified portfolio that includes inflation-protected assets and a mix of growth and stability can help maintain your purchasing power and keep your retirement secure.